Happy New Year and welcome back. It's a new year, new chances, new opportunities, new goals. And if one of your goals is to buy a house, then you're in the right spot. This is where we discuss everything with regards to housing, real estate, mortgage, all of that good stuff. And with me, I have Mr. Josh Lewis. We're not sure if Josh's mic is working or not, so we're going to test this for the first time right now. Josh, you here? Is he not paying attention to us? Is he frozen? That is the question. I don't know. He looks frozen. So anyway, welcome back, guys. We missed last week. I was up in the mountains changing cabins, weird situation going on up there. I had a place with no heat. So last minute had to change things around. And so we weren't able to get on the episode, but we're here basically back to update you guys on what's going on in the market now, talk about, what's coming out tomorrow, which is inflation data, right? We're going to talk about inflation data in a little bit more detail using some charts here in just a minute. But that's really the big news, right? Not a lot's happened in the housing market since our last update, right before the new year, other than just kind of chugging along a little bit, and that's more or less what I expect to happen in the housing market, probably for the next couple of months until you see some inventory pickup or until you see something happen with interest rates, which at the end of the day is probably not likely. But, when we start talking about inflation data here in just a minute, there's an opportunity for the inflation data to really exceed expectations as to what the market's expecting. And if that happens, there's an opportunity for the bond market to rally, which in turn could bring rates down. So we're going to dive into that. I'm hoping that Josh jumps on here in just a minute. But what we're going to do is start with some other charts before we get into the housing data. And then you guys start putting your questions in. And as we go over this data or finish this data, then we'll start discussing and answering those questions for you guys. So let's do this. Well, all right. Josh is coming in.
Look
Josh,
at
you're
this
working.
guy.
Look at this
Yeah,
guy coming
should
in
be good
hot.
now.
Coming in hot.
Coming in
First
hot.
episode of the year. It's 2023. And you started off with a crappy mic, so it's all good.
It was
But
a technology fail.
It was a technology fail, but you got new lights in the background, makes up for all the craziness there. But we're going to start looking at some of these charts. Josh, I just kind of said market's been chugging along. The real news comes out tomorrow. And what I mentioned in there is that there's an opportunity for the the actual print on inflation to exceed what the market's expecting in a good way, which could cause a rally in the bonds and in turn help interest rates out. But we're going to dive into those after we check out some of these other charts. And for those of you guys who are listening to this on the podcast and not watching it live, we've also started a community, that you can get in either the description of the video. If you're here on YouTube, it's in the chat there, pinned at the top. If you're on the podcast, it's in the body of that email. And it's essentially a community for first-time home buyers, for buyers, sellers, anyone in the housing market, interested in the housing market, interested in housing market data, interested in what Josh and I are reading, the charts that we're looking at, all of that stuff. And it's a free community. So go in there, join it. We'll be updating it along the way. We're just getting it started, as of yesterday, the day before. So we're just really starting to put some information in there. But if you're looking for a way to see the charts that we're looking at, if you go in there, all of these charts are actually going to be in there as well. So with that said, first chart here is total inventory for the U.S., currently sitting at 471,349. So you can see we're below the peak that we were, just a couple of months ago. Inventory is actually probably more or less leveled off in a lot of markets out there, right? You're through the holiday season. You're at a point now where inventory is going to start to move sideways before it moves up. And in most markets, you're going to start to see that inventory continually pick up here over the next couple of weeks. Nothing crazy happening until probably, I would say, late February, early March is when you're going to see the majority of inventory come on. And it's going to pick up through mid to late summer because we're getting back to that normal seasonality. But the story here, the chart shows that, yes, inventory is higher than it was, back in is lower than it was just a couple of months ago, but it's quite a bit higher than it was 2 years ago, but significantly lower than it was going back, the chart shows all the way back to 15. So inventory is still the biggest problem for the housing market out there at the moment, just because, there's a lack of it in the grand scheme of things. Second chart here is percent of properties with recent price reductions. You guys are always talking about price reductions, how they're impacting the market. So this year, we're actually starting off the year with more price reductions than we have in quite a few years. Nearly almost 40%, 36 and a half, 38 and a half. I can't read that from here. Of properties are having some sort of price reduction. Looks like it's ticking down a little bit as the market starts to pick up steam. One thing I wanted to go back here on this inventory chart is Orange County. We started the year, finished the year somewhere around 2,450-ish homes. Today, we're sitting around 2,556. So inventory has picked up a little bit, but still well below, where we were 3-year average prior to the pandemic, 2017 to 2019. We'd be starting the year somewhere around 6,500 homes. So just some context there. Huntington Beach sitting at 164. If you guys have been following this at all, those numbers are quite a bit less than where we were at the end of the year. I found this chart pretty interesting, Josh. This is the number of mortgage-ready customers who can potentially qualify for a mortgage. Across the bottom, it shows interest rates, and along the side there, it shows how many people can actually purchase, at that rate, right? And then you have, each line represents, a price point, if you will. And you can see as rates go lower, significantly more people can buy homes. But once you get to 7-8%, which are rates that I don't think we're necessarily going to see again, the people, buying homes in that $600,000 plus price point is in the, low single digits. Whereas, if you're, $200,000 mortgage, obviously significantly more people can afford those. But in most markets out there, you don't really have a lot of the homes in that price point these days. It just shows you how much interest rates affect affordability and how many more people can actually purchase homes with lower interest rates, which
And
talk about here in just a moment with inflation.
Jeb, that matches up really well to what I'm seeing. I told you something yesterday and it closed the loop for myself last night. I've been very, very busy, but busy doing what? Well, it's talking to a lot of people who either don't qualify, which that's less of the situation, versus people who don't qualify for what they want. People who a year ago at lower interest rates, 2 years ago, lower interest rates and lower prices would have qualified, but exactly what you're seeing at this chart. So plenty of people still wanting to buy homes. The affordability is the big issue. And as we've seen interest rates trend down, interest has picked back up, and it's helping people at the margins of qualification. So if you're able to get a little bit of a price reduction, interest rates come down, every little bit helps in terms of getting people into homes with payments they can afford and supporting the market. But definitely seeing less people qualifying now than where we were 2 years ago because of higher rates and higher home prices.
Yeah, no, it's interesting. I mean, I was talking to a buddy here earlier today. We were at office meeting. Actually, I wasn't talking to him. He spoke in the office meeting. He said he's in Westminster, which is here in Orange County. That's where the bulk of his business is. He said there's not one active listing in all of Westminster at the moment. It's crazy. 3,000 homes, 3,000 homeowners in Westminster, not one active home in the entire market. Pretty crazy, right? I mean, and he's got one coming up this weekend, which is showing you like, I mean, and he'll get activity on it because it's the only one. It's a hot market, what have you. I mean, our building is kind of turning into the new real estate, I guess, / mortgage building here locally, because there's quite a bit of, real estate offices moving into the building that we're in. And there's an escrow office now and so on and so forth. But I as I walked in the office a moment ago, there was a girl walking by and I heard her on the phone with a client saying, yeah, I just got in touch with the agent. They have multiple offers. They're going to be countering the highest and best offers. And so I'm like, well, guess what? I guess the market is still moving along, just like we had discussed. But nevertheless, so we're going to start looking at some inflation data at the moment. And we're going to talk about how some of these things are likely going to show in the print tomorrow. But this is apartment leasing traffic, basically just showing it's going down, lowest level since Q4 of 2013. This one right here is Supply Chain Shock Reversed, is the title. Josh, what are your thoughts on that?
Yeah, it's freight containers, and it's a good piece of forward-looking data. And that big spike in prices was during the pandemic. There was way too much stuff getting put on container ships, into
Mhm.
containers and on ships. You remember we showed the pictures of the boats, the ships stacked up here, ready to get into the port of Long Beach, and we've basically seen that normalize now. So that is a sign
Okay.
that the big wave of inflation has crested and is normalizing. So it's just one piece of data, but we're going to go through a bunch of them here.
Next one, used vehicle prices, or did I say vehicle prices? Used
Vehicle.
vehicle. That sounds weird. Vehicle. Used car prices obviously have come off the highs. Josh, this chart shows used cars are coming down, but what I can tell you is there are certain cars out there that you still cannot find, and if you can find them, they're still selling at a premium. But nevertheless, what are your thoughts on this one?
Well, look at that index. You know, it had slowly crept up from 2009 through 2019 to about a 150. However, they're judging that's just a baseline, so 150, and went up to what is that 275, and we're down to about 225. So 225 above 150 is a full 50% higher. So it's great that we've seen a correction. We still have used auto prices higher than they need to be, but the trend is going in our direction. And remember, we don't have to like where prices are to acknowledge that inflation is not present, because we're seeing deflation in these prices, even though we're still at elevated car prices that most people aren't comfortable with.
There you go. Disinflation. So this is manufacturing, Josh.
So yeah, we got the ISM figures for manufacturing. Shows prices paid, delivery times, production, number of new orders. So just multiple different numbers in there showing anything under 50 is contraction or
Yep.
disinflation. So it doesn't mean that prices are outright dropping. It just means that all of the activity is again way down. And we're looking, you know, some of these numbers have crested up 70, 80. So those are really, really hot numbers. And now we're looking at numbers that are showing contraction in manufacturing.
All right. And so earlier I had sent Josh a video. In fact, I believe this video is actually posted in that community that we talked about earlier. That's there on the right-hand side, but it's Steve Leisman, CNBC, talking about the idea that you could possibly see a negative print tomorrow with regards to inflation. And this is showing a 3-month annualized print of the inflation measure. Josh, what did you want to say about this one?
Just looking at the trend there. So even if we say so a couple things, this is services inflation. Services have been the big problem because we've seen as the supply chains got solved for most goods, we're not seeing goods inflation. It's services inflation as people come out of lockdown, wanted to go on vacations, wanted to go out to eat, all of that stuff. But it is absolutely moderating. So November of 2022, that 3.17%, still above what the Fed wants to see. All of their inflation rates they want to see at or below 2%. So 3.17 is 50% above that. But when you compare it to 12.22, it's wonderful. And you can see that trend is going straight down. So again, the high frequency data suggesting a big retreat tomorrow. So Jeb, do we have that other chart there showing the month over month?
Yeah, so this is just a headline CPI, which currently sitting at 7% based on the last reading there. Consensus tomorrow, as you can see, I kind of put it on the left there, expecting a 6.5 year over year number, 0% month over month, and that would be down from 7.1% of last month. And then if you look at core CPI, similar story here. Consensus is for it to drop to 5.7% from 6% last month. That would be 0.3% month over month drop. And yeah. And then do we have one more? Do we have one more?
Well, we have the
Yeah.
bigger chart there of just
Yeah.
showing.
And we've showed this chart several times to you guys. So what we're looking at here is this 0.6, right? So the 0.6 is what's going to fall off if you look at December, the one that's not highlighted. And if it was replaced with the consensus is 0.3, right? So if it's replaced with 0.3, that shows inflation is going down, right? We've talked about this several times, how they measure inflation is you take all those little monthly numbers there, you add them up, and that gives you your core inflation number based on this particular chart for the entire year. So it would show a retraction in inflation. But what happens is if you look at that chart, it's expecting 0.3. If it comes in at 0.2 or 0.1 or even 0, that's a bigger drop in inflation, which is what could potentially cause, what we saw last time, which is a huge bond market rally after that release, Josh.
Yeah, if we're at 6%, it takes a month-over-month reading of 0.5% of inflation to stay at that level. So anything under 0.5% is going to be improvement. The market's expecting 0.3. So 0.3, if we got that every month for a year, would have us at 3.6% inflation. Would look great to everyone relative to last year. But again, no one's super comfortable with that because we're up 7-8% over the last year, and then it's 3% on top of that. So everyone is looking for it to moderate to 2%, but it will be very interesting to see the numbers tomorrow. We got a tame number on the October report that was released in November, the November report that was released in December. But what we saw is through the holidays, we talked about this on a couple of the shows. You see really thin trading as most bond traders are taking vacation. So you get weird movements. And so rates improved for a week to 10 days after the CPI figure, the last Fed meeting, and then they got worse through the end of the year. We've seen a little bit of that come back, but everyone is waiting for tomorrow's figures. And we were lucky. The last two meetings were on Wednesdays. So we got to get the data in the morning, come out, talk to you guys about it on Wednesday night. We're going to have to wait a full week, but it will be interesting. That article you sent over, the video you sent over, Jeb, saying there is data indicating that we might actually see a negative print for tomorrow. That would be a big shock to the market. What it will do, we've seen the 10-year between the 3.55, 3.65 over the last week or so. We've got strong resistance at 3.54 and then at 3.50. If we had a number anywhere near 0 tomorrow for the month over month, and especially a negative, we're going to see that number drop rather rapidly below 3.5%. And the questions are really going to start coming at the Fed strongly of why are you still talking about increasing hikes when we're seeing such rapid downturns in inflation in the month over month reads when every time they get in front of the podium and talk, they're talking about lagging data and they're saying, oh, it's not quite where we want to see it. Well, it's not the high frequency data like we're talking about. And when people talk about high frequency data, it's a lot of things that traders have access to, industry reports, not government level things that are released on a month over month basis. So everything, we've gotten to a day and age in the internet where people want information and they trade off of information. So they're digging way deeper and they say, okay, cool. Next month, the government's going to report this. What are all the subcomponents there and how quickly can we get to it? So I would be surprised if we don't have a surprise to the downside tomorrow in terms of the month over month read, just because most of those traders who are betting with real money, it's their livelihood. They wouldn't be putting their necks out there. We saw a 10-year auction today, Jeb, that it was graded a C+, but that's much better than the 10-year auctions were almost every month last year. So that's saying some traders are willing to get ahead and do some buying before tomorrow's CPI figures, thinking they may be sitting on some gains if that 10-year treasury drops tomorrow based off of the CPI data.
Yeah, and I mean, and at the end of the day, like none of this means that the Fed is going to pause in February, right? So they don't meet in January. So what we've seen after the last couple of inflation prints is that the Fed literally meets the next day or the following week, and so they're able to come out and kind of either calm the markets and or give expectations as to, what they're doing. This month, you don't get that, right? You've had a lot of Fed members out there talking to the media and giving their thoughts and they're still really bullish or hawkish, I guess, on the market in general. And saying that they're going to continue to do it. Rates need to go significantly higher. They need to stay there, so on and so forth. So the question is, after that CPI number comes out, again, if it disappoints and the inflation numbers are at the expectation of the consensus, if you will, probably not a lot happens. If they're higher than the consensus, that's not good for the market, right? I mean, that proves that what they're doing is not correct. And if it comes in significantly lower, then that's a good thing. But do the Fed members automatically pivot immediately? Probably not. I mean, I think there's a really good chance that you're still going to see at least 0.25% in February, just because probability and what the expectations they've set. But a lot of it will come out in their conversations with the media, over the next, week or so, and maybe even this week, depending on, when the what happens with the data?
If you're just reading the data over the last 90 days, you look at everything the Fed has said and you go, are these people just have their head in the sand? Do they not actually watch the same news that we watch? But there is a reason for that. They were aggressively hiking since last June was when we really got serious with the 3/4 point hike after the June inflation figures came out. And markets are forward looking. So if the Fed, before they're ready to level off and stop hiking rates, if they say, hey, we've done an awesome job, we totally have this under control, then markets are going to say, cool, we have a dovish Fed, they're going to stop these hikes, we're going to have lower rates, we can have better financing. Markets all around will trade off of that. So they have to keep up that hawkish rhetoric as long as possible, even if in their meetings they were really talking about we're close to the end, we may cut at the end of the year. So not only do we have more data coming out and the data is getting weaker by the day, indicating that they're going to have to change and pivot, but they're not going to change what they're saying because they want the market to think rates are going higher and going to stay high for an extended period of time. You know, Jeb, the one do we have in there what the projection is? That chart, did we have that last one in there?
Which one? For which one?
Is that this right here? So
yes.
Here's the green line is what the Fed themselves are saying. At the end of the year, we're going to be at 5.25. We aren't touching rates in terms of decreasing or loosening until 2024. This is the Fed funds futures market, 4.6%. This red line is actually, what does it say? Is if something breaks.
Right.
So they go too far, the economy really hits the skids, they could end up all the way back down here. And I mean, this is like in case of emergency break glass, like it is highly unlikely, but it is a possibility based off of this. So it'll be interesting to see. I think that green line is your worst case. The black line's probably a little bit more likely, or say somewhere in between there is a little bit more likely, but the red line or something well below the two top lines is possible if we continue to get really bad data.
And let me tell you, if you see the red line, it's not good either way, because that means the economy is in complete shambles overall. So it might mean rates might be lower, but it might be more difficult to buy a house for a lack of employment or other reasons out there. So nevertheless,
let's talk about that. This is how we got here. Home prices are higher than they should be, and affordability is lower than it should be because the last two times the economy has gotten into trouble, the 2008 crisis, 2007, 2008, and then COVID, our government said, let's subsidize the ever-living heck out of rates and make them very, very low. So the people who could qualify and could afford pushed those asset prices. If you owned assets, whether it's Facebook stock, Netflix stock, Amazon, any of those, Tesla stock, or you own a house, those shot to the moon based off of the availability of really cheap credit. So we get to the next crisis. If they go back to the same playbook, what it does is it continues to push home prices higher. So for those of us here, we really, really don't want that. We would hope for some sort of Goldilocks outcome where rates improve or are better. If we got rates somewhere back into the 4 to 5% range, I think it would give us an extended period of relatively flat home prices, slightly up, slightly down, with higher affordability, where people can move if they need to. You can give up a 3.25 rate for a 4.25 rate, where you're not going to do that for a 6.25 rate. It would open up the market and open up some homes that are not available to folks right now.
No, good stuff. I mean, Eric, one of the viewers here just says, just go to the grocery store. Inflation is still high. So yes, prices aren't going down. That's what you have to understand. Like, most prices that are there are going to stay there. You're just not going to see continual increases in prices going forward. That's the problem with inflation, is that rarely do you ever see the prices from previous times. Now, some things will adjust, with supply chain issues adjusting and that sort of thing. But things like food and just certain items out there, you're not going to see a big drop in prices. You're just going to see less of it increasing in the future.
So think about that comment. Go to the store, grocery store. Inflation is still high. That's not correct. Prices are still
Yeah.
high, and prices will remain high because we're not going to get deflation. The Fed's preferred number is to have inflation somewhere around 2%. We've had it slightly lower than that, slightly higher than that for about 12, 15 years right now. So coming off a hot year of 7 or 8%, you're going to continue to see 2 to 3 to 4% on top of that. No one's going to like these prices for quite a while.
No, good stuff. So what we're going to do now is we're going to dive into some questions from you guys. Before we do that, though, I'd love to know where you're watching from. Are you in the U.S.? I assume so. But just put in your city, state, where you are. Love to know where you guys are watching from at the moment. It's always good to get that feedback and be able to provide you some local information if we can. So just throw that into the chat, guys, and then we'll plot it on our little map like we've done in the past. All right, Josh. We got some New Jersey, some New York, North Carolina. Good old North Carolina. You got Rafi in there.
In his new home in Temecula.
There you go. Let's see what we got here. So this is this chart here. Let's chart it. Can we zoom in? So that's what that looks like. And let's throw it in the stream there, Josh. It's kind of clustered, isn't it? I mean, is that weird?
It only seems that way. Like everyone's hanging out. It's like watch parties. There's like
does it not seem clustered though?
Yeah. There's five people in 5 different areas that like to hang out and watch this.
Yeah, like are you guys all in the same room watching this, talking? I mean, it's like there's middle America. We don't serve those people at all, which I feel like is really weird. Like the one person in Raleigh didn't even show up. Oh, no. If you click it, I'll see now, if you go really granular, it helps.
Then you can start seeing more people. Oh, that's what it is. It's only showing where the multiple people are unless you, the onesie twosies. I got you.
Come down here. You've got what, one in Aliso.
Now we can see where Rafi is.
Yeah. So there. Should we zoom in all the way to his house?
You're going to be swatting him. There's going to be people showing up at Rafi's house for the party.
Can we drive down? But anyway, I think that chart's always interesting. 10 looks like more's on the East Coast. You guys are more home buyers out here. We got Run in Raleigh, Richmond. Looks like Northern Virginia, DC area. What is that? Kingwood,
West Virginia.
Look at that. Kingwood, West Virginia. Anyhow, all right. Good stuff, guys. All right. As we'll keep doing it. No,
Rafi says you're not allowed to dox him here on
I see it
on the live.
All right, guys. So continue to put your questions in there. We're going to get through these. We're going to try to answer as many as we can tonight. Let's see. A lot of these questions are the same, so I'm going to just kind of hold off for a minute and see how many more come in before we get it. Let's just talk about this, Josh. We kind of talked about it a moment ago, briefly, but not really. MV says, is there going to be a potential recession or a global recession? So, yes, I think, right? I think at the end of the day, there's the likelihood that you see more of a global recession than you see it just concentrated, say, in the United States, just because of, everywhere, every country at the moment is having to, do some sort of quantitative tightening or actually quantitative tightening across the board. And we're seeing that because of inflation and other things. And so the likelihood that you see a recession, I think, is high. I mean, I don't think the job numbers are, I wouldn't say accurately reporting what's happening. I just feel like some of this information is somewhat delayed in getting to the numbers. And so to the final numbers. And so I think, when you see companies are continuing to lay off, companies that haven't laid off in quite some time starting to lay off, that's going to be something that has a bigger impact. The question is, how much of an impact does it have, right? Are we going to see, unemployment numbers where we saw during the last housing crash at 12%? I don't think so. But as you see unemployment go up, typically what happens is, I think there was a number out there, Josh, if you saw unemployment at 5 or even 6%, was it 5%, that would almost automatically get inflation back down to the Fed's target of around 2% at that time, just because of the unemployment numbers. But what's going to happen here is if you do see that, or when you start to see that, the Fed's going to reverse course. And so that's when quantitative easing happens. That's when whether or not they start buying mortgage-backed securities or any of that is to be determined. But that creates potentially other problems down the road, because if they don't get inflation completely under control and then they start to reverse course, it goes out to basically what Michael Burry said, which, I mean, the guy's been wrong more times than he's been right. But he did call, the housing crash of '08 and, the Big Short movies about him and all that good stuff. But one thing he said I thought was interesting, and I agreed with, is that there's a chance that the Fed reverses course too early and causes another spike in inflation, which isn't going to happen immediately, but could happen down the road. So, Josh, what are your thoughts?
Well, the reason why, Jeb, that's unlikely to happen is they're looking back at history. That happened in 1980. Coming in the late 70s, Jimmy Carter was president. Inflation was really high. The Fed had been tightening to stop that, and they had inflation moving in the right direction, and they started cutting. And we had even bigger inflation in 81, 82 that led to a bigger problem. So no one at the Fed right now wants to repeat that. So they're going to talk tough. They probably are going to keep rates higher longer than they need to be. It's important to remember that in terms of mortgage rates, we're here talking about housing and mortgage rates and how that impacts everything. Mortgage rates don't move off the rate of inflation. They move off of the direction of inflation. Last year, they were shooting up because inflation was shooting up. Now that we're seeing inflation trending down, it's coming down. As long as inflation continues to trend down, mortgage rates will come down. If inflation starts trending back up, if we get 2-3 bad months, instead of a 0.3, we get a 0.5, 0.6, 0.7 month over month read, rates will continue to pop back up. Don't expect that to happen. In relation to this question, recession is likely. One of the charts, Jeb, that I pulled out of the slides, because I didn't want to bore you guys with too much data for geeks, but in looking at that, it was the 3-month to the 10-year Treasury inversion, and it's as negative as it's ever been. And that, when that yield, those two yields go negative, it has never failed to predict a recession. We did have 2 consecutive quarters last year of negative GDP growth. We came out of that in the fourth quarter. So there's still debate over, did we have a recession last year? Are we in a recession now? And they only call that in retrospect. So our best case is that so-called soft landing is we don't go negative. We go to near zero GDP. So any way you cut it, it's going to slow the U.S. economy, the global economy. And the Fed has come out and said, we are not comfortable with a 3.5% unemployment rate. They want it at 4.5 or 5%. They don't want it at 12%, like you were referencing earlier, Jeb, but they do want it a good bit higher than where we're at right now. And it's been a little bit of a conundrum because they have not been able to impact that. They've been hiking for 6-7 months now, and we continue to see the unemployment rate go down. So their movements have not impacted the employment economy so far. But big picture, absolutely believe that a recession is coming, or at least a big slowdown in the economy. It just remains to be seen how deep and how long.
Good. Let's see here. I guess we'll just touch on this now. Will house prices go down like in 2009? So the easy answer is no. You've seen enough videos, enough people talking about what was different that time versus now. The likelihood, I mean, yes, housing takes a while to unfold, right? So there's a really good chance that you continue to see some housing markets out there move sideways, potentially down. But the likelihood that you see some massive crash where prices go down like in 2009, it's not likely. I mean, we could do, a 30-minute dive into this and talk about it nonstop. But for sake of keeping the show moving on, we won't do that. And it's not me being bullish on housing. It's just you're not going to see the prices from 2009 or the market do that again, just because the fundamentals of the market are different at the moment. Now, could something change in the future? Sure, but that's not where we are right now.
What 2 or 3 things do you think would have to happen to get something even approximating that last downturn?
You'd have to have interest rates go 9, 10%. You'd have to have employment go way up. Those are really 2 of the biggest things probably is interest rates go really high, unemployment go super high to a point where people are distressed and having to sell their properties. They're going to need to sell. And ultimately that would bring house prices down. Third thing, it all goes down to what? Wages. Obviously wages would have to continue to, wages would have to get crushed, which ultimately goes along with the job per, jobs that I mentioned. So I don't know. What's the third thing?
No, really the two you hit it out of the park with those. You would have to have rates go higher, significantly higher. So you'd have to have inflation remain high, pushing rates higher, and you would have to have unemployment go much, much higher than where we're at right now. Because the reason why we're insulated from the downturn is people are sitting on a ton of equity, they're sitting on low interest rates and low house payments. So yes, you can look at it costs too much for someone to buy a home. Most people are not buying their home today. They bought it at much lower prices. They financed it with much lower interest rates. So their payments are manageable, and short of being forced to sell, they're not going to sell. So you don't have a glut of supply. You don't have home prices coming down. But Jeb, you're 100% correct. It would take rates much higher than where they are right now, whether that's 8% or 10%, I don't know. But it would also take employment getting much worse to see anything looking like that. And it doesn't mean we can't have a downturn in home prices, but that big 25% dip in prices would have to be caused by high levels of unemployment and much higher interest rates due to inflation.
Yeah. And we've showed this, times in the past in that the idea is that the data proves to be correct, is that as inflation goes down, interest rates go down. So we know inflation is going down. Is it at the 2% target? No. Is it putting more money in your pocket every month? No, but inflation's going down. So with that, interest rates should follow. Now, is that going to happen immediately? Probably not. We've talked in the past about servicing rights and how some of these other things out there are actually affecting the gap between, say, the 10-year and the 30-year fixed at the moment, that arbitrage, if you will, and how it's artificially higher because of servicing rights and people, not holding on to their mortgages for, more than a couple of months, because if they get the opportunity to refinance, they're going to, and how most of these companies out there at the moment believe that interest rates are going to be lower. And so they're building in this spread, if you will. So we know rates aren't likely to go super high. Now, does that mean they can't go higher? No, it doesn't mean that. I just think the likelihood that they go back up to the peak that we saw over, Chris Stapleton
every time
way
interrupts
of making
us.
it into every conversation we have.
The best part, Jeb, is I'm not gonna dox the person and show their name on here, but the person who just called is actually a watcher, a viewer of the show. They know that we are live right now,
maybe
and they're calling me.
They did it just to test you.
Yeah,
just
to
test
make
you.
Sure
but where I was going is that the likelihood that you see interest rates peak back above that 7, let's just call it 7-ish%, isn't, the likelihood's not high. Could it happen? Absolutely. I just don't think that's where things are headed. So as interest rates come down, that is going to allow the market to continue move. Now, somebody that I respect and read a lot of his information and feel like he's pretty accurate believes that the market needs to see rates below 5.5% to provide some stabilization in the market. And anything above that 5.5%, you'll continue to see house prices slowly decline. I don't necessarily disagree with that. I think there's a lot of truth to that. In that, because of affordability and because the lack of inventory, you're going to kind of see the market stall at the moment. But as rates go down, you're going to see some of the activity pick up. So, Josh, you want to elaborate on any of this, or are we moving on?
No, we're good to move on, but let's throw this one up here, because this kind of goes back to the previous question. Inflation's not going down. Go to the grocery store.
Real inflation.
Prince says real inflation is not going down. It's just year over year. Year over year is the real number. Currently, we do not have the high levels of inflation, but prices don't go back down. If inflation drops down to 2%, they don't go, hey, let's ignore the year or the half a year that they were at 7-8%. Those prices stick. So was that inflation real? 1,000% it was real. It doesn't go away. It doesn't stop the pain there, but that doesn't mean that what we're seeing right now is not real. It's 100% real. Inflation right now, today, on a month over month and year over year basis is not a problem. We will see what happens through the rest of the year. We've gone through this before on the show, Jeb, the difference between core CPI and overall CPI. Core because the Fed strips out food and energy because they can't really control the prices of food and energy. Those are the two things that are going to be difficult, that could get away from them, because we in the US don't have a lot of control. The food supply is global. The energy supply is global. Those things could get out of hand. And cool, it's all possible, but what is happening right now is 100% real. It just doesn't mean that the price hikes go away. I don't know. I think you and I talked about this, Jeb, but I don't think we talked about it here live. I went into the Habit Burger last week. I get a salad. That salad used to be $13, and for $2.95 you get a drink. So $16, I would eat my lunch. Well, last year it went up, and I walked out and it was $18. I'm like, well, that sucks. That's $2 extra. Well, I went in again. It was $21, just shy of $21. That's real. That's painful. That's unpleasant. My thing that cost, $16 2 years ago is now $21. That's pain. But the fact that it stays at $21, they're not going to cut it because their prices are unlikely to go down. What I wanted to say in this, Jeb, you've heard this before. The cure for high prices is high prices. The cure for high rates is high rates. The demand, it destroys the demand. High rates make things that need to be financed cost too much. High prices makes things cost too much. So inflation is self-correcting over the long haul because you destroy the demand. But you can't say that what we're seeing right now is not real. It just doesn't solve what we went through the last 6 to 12 months.
No, and on top of that, one thing we didn't even touch on when we were talking about inflation data is rents, and how rents are calculated in those numbers, and how at the moment those rent numbers are reading, I'll say artificially high, just based on expectations of rents, and how they're calculated, that new rents won't be going up at those levels and what have you. So as those numbers adjust over the next couple of months, that could also allow that core inflation number to come down even more. But again, not something that we talked about. But Alex has a question here. Josh says, would it be fair to say that if inflation comes back down, the Fed would not care if the unemployment rate stays low or even goes lower?
So my knee jerk, Jeb, when I saw that question was, no, I don't think anything would change their mind. But you're like, that's because they've beat into us that they believe that such ultra low levels of unemployment like we have right now will lead to wage inflation. When there's more open jobs than people to fill them, employers have to pay more and more. We saw this during the pandemic when fast food jobs went from $12 an hour to $18 an hour. There weren't enough people willing to do those jobs. You have to pay more. That's wage inflation. Those people that now have 50% more income are willing to buy more stuff, pay more for stuff. So if we saw inflation go down and unemployment stayed at the current low levels, at a certain point, if it's 6, 12, 24 months down the line, you'd think they would have to rethink the theory that low unemployment has to lead to wage inflation if they had a long enough timeline of data saying that it doesn't.
Good. Let's see. Riano Keeves. What's up, boys? Long time no see. Also, is it just me, or can anyone else on the street do a better job than Powell and company? Yeah, it's a lot to look at, right?
Tough job.
It's a tough job. Nobody wants that job. No one wants that job. And with it comes a lot of expectations and, a lot of headaches. So I can tell you, yeah.
I was going to say, Jeb, that's not us saying it's a tough job. Is not us saying they did a great job.
No, not at all.
The thing that you point to is this time last year, they were still buying mortgages and treasuries a year ago. I mean, that was insanity that anyone outside of the Fed knew. So they're in an academic ivory tower. They rely back on theory. Going back to the last question, would they give up on this belief that they have to raise unemployment to correct inflation? I don't know. They look at textbooks. They deal in theory, and it's hard to get them to look at the real world going on around them.
Now, good. Yeah. Again, I'll just go back to, I don't want that information. I mean, they have the best data in the world.
And they're smart. Very smart.
But here's the problem is you got a lot of opinions, right? There's a lot of it. I can't say that word anymore. Can I say Indians and not enough Chiefs? You can't say that, right?
No, I think you can, because Indians and Chiefs, you're just...
There's a lot of cooks in the kitchen with a lot of opinions on where the market should be going, what it should be doing, and all of those influence the Mr. Powell there. And so it's, again, a job I wouldn't want. So, but anyway, Tom tuned in tonight just to see where my beard was at. Want to know if it was a full day, a day 2, or a homeless beard. or day 3 Viking beard. So it doesn't quite progress that fast, but it's, the beard's there. It's somewhat trimmed, keeping it somewhat maintained. I looked back from some pictures last year and I was like, holy cow, dude, that thing was out of control. So that was like 3 months. I don't think I could do that again.
I am sad that it's January and October is 10 months away because, well, actually you have 10 months to grow that beard, because I now expect with the blue eyes a full Viking 12-inch beard costume for next Halloween. I'm going to tell your wife that you are going as a Viking.
Halloween. I don't know that I can do it, but don't count me out. We got what? Gunturi. I don't know. G-Wagons, steep discount. Luxury watches, steep discount. Yeah, a lot of that stuff. I mean, God, I follow this one guy on TikTok. I think everybody follows him at this point. I don't even know his handle. But I just watch him sell watches and negotiate watches. And he's a big Rolex guy. I'm not a big Rolex guy. He's a big Rolex guy. But it's just amazing for them to talk prices on some of this stuff and where the prices were versus where they are now. But yeah, those are getting affected and coming down quite a bit. John in Indiana says year over year for December, they're still up 18%. So those are crazy numbers, man. Indiana, I don't know where Valparaiso is in the state related to, relative to other major cities. But what I will say is that, job growth there is good. Cost of living there is overall good. Home prices are still relatively affordable on a national scale. That drives people to want to go to those markets. And because of that, those markets will continue to probably do better than some of the markets that shot up like crazy that are now overpriced. And I say overpriced relative to that market. And, those are markets also where investors can buy property, and it, makes sense still. So
this is all anecdotal information. Yep. But I hosted Vetted VA Live last night, had a guest on, a loan officer in Wisconsin, another one on in New Jersey. The gentleman in Wisconsin lends kind of throughout the Midwest, or a little bit north of Indiana there. And he was saying, haven't really seen prices come down, but buyers have a lot more power. We're getting lender credits and seller concessions on almost all of our deals. And then the gentleman in New Jersey, he said, it really depends on where you are. And I will get it wrong, whether it was South Jersey or closer to the city. One of these areas, he said, the market never really got hot around here. The buyers always had power. And in the other part, it's still a seller's market, and buyers are still going in and having to overpay. So it really goes back to what we say. We have a lot of information on here. A lot of people are seeing numbers and figures in their area, or they know what their neighbor did or what their uncle 2 cities over. But it is all real estate's local, and we have very different markets based off of affordability and local economies.
Yep. Let's see. Marion has a question. Just out of curiosity, would any of you two consider buying a rental property this year? Absolutely. A rental property is less emotional. It's more or less about the number. So do the numbers make sense on that property? That's ultimately what an investment property comes down to. Does it make sense for what you're trying to accomplish with your portfolio, with that particular property, what have you? And if it makes sense, great. If it doesn't, that's okay too. Just look for the right opportunity. There are still opportunities out there in this market. States like California, it's can be difficult to have the cash flow and make some of these properties make sense. That's why people are, go out of state with their money. But investment property is again, in my opinion, you should be less worried about picking a top or picking a bottom, and just primarily looking at the numbers and figuring out, do they work?
Jeb, that's exactly what I was going to say. Is the numbers never lie. Pencil them out accurately in terms of what you can rent it for, what it's going to cost you to acquire it, how much cash you're putting up, and what your cash flow looks like. I've got a couple of examples here. One of my buddies, he does estate sales. He calls me yesterday, house in Anaheim, says, "Hey, if you want, we can get this for about $700." And I'm like, okay. 700 is a good price for any single family in Anaheim right now, but it can be a really good price, or it can be an okay price. So I look it up. It's Loera School District, very good schools, right near Disneyland, very good neighborhood. I look at it, house looks nice from the outside. I look it up, and safely $900,000 value, and best case would be almost $1 million. Some homes in the neighborhood have sold for $1 million. If you did it really nice, you might get that much depending on how the spring plays out. But I said, what I really would like to do is acquire some rentals, and you're sitting there with a bunch of equity on that. And I run the numbers, and at current rates for that home, even getting it at $200,000 below market, there's no world that makes sense unless you're comfortable with making a massive down payment, in which case your rent yield is small relative to how much money you put down on it. Or if you're comfortable feeding it and actually writing a check to own that home over the next 12, 24, 36 months, which I am not. So you look at that, and then we look relative to other areas. There's still areas around the country that if you put 20% down, I have a client, I believe, Jeb, he actually is a show watcher here, that he bought a rental property in Wisconsin last year. Doesn't even own his home. He rents, but he bought that house. His mortgage payment with 20% down on that, his mortgage payment is $1,100. He rents it for $1,850. Like, why wouldn't you acquire that? Unless you thought rents were going to drop. I think most people would be happy to acquire rental properties with a $500-600 a month positive
How do I
cash
buy
flow.
one of those?
Yeah. I will ask him because he's a cool guy. He'll explain to me how he came across that. Was it a smoking deal? Like, the thing that I would say, I would not buy anything retail right now. I wouldn't be looking in the MLS and going out and competing against home buyers. I would want off-market stuff. I would want, distressed properties. There's not a lot of them. So we're not talking about foreclosures. We're really talking about off-market stuff. Driving through a neighborhood and you see a house that's trashed, it's a numbers game. You have to reach out and do a lot of research, but there are deals out there. So if I were buying, I wouldn't be playing the retail game out of the multiple listing service.
There you go. We're going to move on. Mr. Jared Lee says, should you put more or less down on a house during this? And I assume during this is the slowdown in the market, or whatever you want to refer to now as. Some people are calling this the crash. Josh just turned on his lights.
I just turned the damn lights on.
This guy. But putting a down payment down on a house is really, I wouldn't say there's a set amount you should ever put down. Ideally, most people shoot for at least 20% because it helps you avoid mortgage insurance, right? But if you've been on the show, or you probably haven't been on the show, but if you've been listening to the show for any extended period of time, we've talked about how if you have multiple borrowers on a loan, you have high credit scores, mortgage insurance is relatively inexpensive, or can be relatively inexpensive compared to the amount of money that you would save by not putting 20% down. So it becomes a personal preference. Josh always says the numbers never lie. And this is one of those, things that you should run by a mortgage professional when going through the pre-approval. Is like, hey, what does 10% look like? What does 20% look like? What does 5% or whatever the numbers that you want to run look like? And go with what you're comfortable. I mean, if you're only comfortable putting 20% down because you just don't want to be extended every month, or that's the number that, you've got allotted in your budget for housing expenses, then by all means go with that number. But at the same time, I'm a believer that you can put a little bit less money down, keep some money in the bank for a rainy day or for whatever it is you want to use, and still buy property, and not have to worry about, the market in general. We always talk about longer term time horizons and that sort of thing. But, if you've got money in the bank, you're comfortable with the payment, all of those things are important. But ultimately, it becomes a preference for you at that time.
Jeb, we've talked about this on the show before. Jared Lee, if you're interested, go over to Amazon, look at a book, Misfortune. And I think Misfortune 101 is this little version of it, and versus the 600 or 700 page. It's a little out of date now, but it's a financial planner named Doug Andrew. And his philosophy is you only want to do one of two things. You either want to pay cash for a house, or you want to finance it to the maximum leverage that you can. And the philosophy there is, if you're worried that the housing market's going to go down or something might change in your future and you could lose the home, you don't want to lock up your money inside that property. You would rather have it free, where you can invest it in other things, grow it. But obviously you have the constraint of what you qualify for. So kind of circling back to a really good point that Jeb made, I've got two very good examples. We have a loan that should close tomorrow. I believe it was $899 purchased. People put 10% down. So we're seven something loan, or no, 810 loan amount on that. And their mortgage insurance with 10% down and very good credit and 2 borrowers was $90 a month. So would I rather pay $90 in MI or put another $90,000 down on the home? I would much rather put 10% down. And those folks can afford it, and they didn't have the 10%. Another one talked to today, $1,570,000 purchase price, and looking at putting 10% down. The mortgage insurance on that, again, very high credit scores, 2 borrowers, was $157 a month. Would I rather pay $157 or put $157,000 more down? Run the numbers, take a look at it. Don't be afraid of mortgage insurance, and other things being equal, stay liquid. I would much rather someone have reserves to fall back on if something goes hard versus equity locked up in their home that they may not be able to get out in time of need.
Good. Let's see here. I saw a comment a minute ago and I was confused by it. John says, "Hey, the other old guy is back." So when he says "other,"
you're the only old guy here. So what is he saying?
Old guy here, and I'm confused by who the other old guy is because I only see one of you here. But nevertheless, John, watch it, bro.
John, if fellas as young as us seem old to you, you've got to be like 14 max.
Oh yeah,
max.
He's like 10. Old. It's probably my son. Let's see
That's
here.
his alias.
All right. Let's go back up here. There's some good questions. Or here's one. Pixel Perfect says, a friend closed a few days ago at 9% below the list price using a 30-year fixed, was able to get 5.375% on a jumbo loan. Saw it myself on his loan estimate. Is it possible to get such a low rate these days? This was in South Orange County. So Josh, jumbo loans, a little bit different guidelines, a little bit different rates. Is 5.375 realistic?
Well, here, the gentleman with the $157 monthly MI, we ran the numbers. They have a big seller concession negotiated. So he was looking at doing a temporary buy down, a 3-2-1 buy down. And we switched over and looked at using 3 points to buy the rate down. And he was going to be at 5.25. So 5.375 is incredibly aggressive. I'm not calling anyone a liar. I'm not saying it didn't happen. Generally, when you see things like that on jumbo loans, what you're looking at is some type of private banking relationship where banks want to keep their large depositors happy. So they will offer them really aggressive terms on the loans. They're not making much, if any money, especially if they're selling it. They can't sell that loan at a profit. So they're really looking at keeping that loan in portfolio, most likely to keep a customer, a good customer, very happy, because that would be really hard to find. We have some of the best wholesale lending relationships out there, and I don't have anyone close to that.
All right, there you go. Michael asks, how long are pre-approvals good for, Josh?
So they're good for as long as the underlying data is still accurate. So the actual documents will expire. Your pay stubs have to be within 30 days, your bank statements within 160, your credit report within 120 days. So if those expire, we'll have to get updated documentation. But the bigger picture, if you want to know, is my pre-approval still valid? Do I still have my job? Am I still making as much money? Did I buy anything that I now have bigger payments? Did I miss a payment where my credit scores go low? Did I go to Vegas and blow my down payment? Or did my wife, girlfriend, fiance, boyfriend, husband, significant other do any of those things? So as long as nothing changes in the underlying information, we have clients that will look for 4, 5, 6 months before they find a property. And in general, it's okay. It's been 6 months. We need to pull another credit report. I need your most recent pay stub. Get me your last W-2 and 2 bank statements, and we're fresh. But we're always going to have that conversation. If you think it may be a longer timeline, it doesn't mean don't do the pre-approval now. It just means be prepared to refresh it and be prepared to talk to your lender and let them know if anything changes.
Yeah. And at the end of the day, if you need a relationship, an expert anywhere across the US, there's a link scroll on the bottom now. A lot of you guys have used that before, got connected, reached out and thanked us for that. So use that. If you want to get connected with Josh, want to get connected with me, that will get you there as well. Brianna has a question. It says, do you guys expect home builders in California to do any rent to own? And no, I don't believe that'll happen. Builders aren't in the business of holding on to property and renting it back. I think what happens in these scenarios where builders have property, California is not really your your market for it for the most part, just because, that I've mentioned this stat before, but Dallas, Texas built more homes last year than the entire state of California, just because of regulatory fees and what it takes to build a house in California, how much it costs to break ground, all of that stuff. But nevertheless, what you would see in a market that had a surplus of homes that they couldn't sell for any reason, they would sell it to an investor, one of the hedge funds, the BlackRocks, those types of things. That's where you see more of that stuff happens. And they might do some sort of rental deal, but we're not seeing a lot of rent to own at the moment. I'm not seeing it. Typically, you see more of these lease option to buy type things coming from sellers in a down market. But we're not there yet, and builders aren't in the business of doing that type of sell and or financing to start with. So I don't think it's going to come from a builder. Ali, what is your thoughts about living in a rental property this year, then try to buy a house around Q1 of 2024 with stable price and rate? So Josh, we've talked about the idea of waiting in this market. Is there anything wrong with waiting? Is there a rush to buy at the moment?
No, not really. If you watched the podcast and went through our forecast for next year.
You can't watch the podcast, Josh, because you haven't uploaded the videos yet.
But I did produce it, so it's ready to roll. So by next week, you'll be able to watch the podcast. But for now, you can listen to it because Jeb did a wonderful job on the audio production and got it up while I was not holding up my end of the bargain. But in talking about our forecast for the next year, we think the most likely outcome is a small dip in prices to a very small increase in prices. So long story short, prices not much different this time next year than where they are right now. So cost of waiting, probably not a whole heck of a lot there. And we also think that interest rates will be lower throughout the course of the year. Now, once we get to the second half of the year, we'll have to start projecting forward. Maybe they bottom out towards the third quarter and are increasing by Q1 of next year. But in general, rates should be better than where they are right now. Prices shouldn't be significantly worse. The only thing you're missing out on is any principal reduction of making 10, 11, 12 payments this year. So if you having another year of watching the market, of getting insight into what's happening, getting a comfort level, saving some additional money, getting a comfort level with your job situation, living situation, maybe you have a raise coming, you're going to finish a master's degree this year, income's going to go up. There are some very valid reasons to wait, and there's not really any, pressing need to buy. Jeb, you remember during the COVID mania of home prices going up, we're like, if you want to buy, you need to do it now. We don't know how long rates are going to be this low, and prices are going up 1% or more a month. So it's only going to get more expensive. That pressure is gone.
Absolutely. And here's the one thing I'll say. This isn't to get you to buy a house. It's just something I read and I saw it, and it's something that stuck with me. You're always paying a mortgage, right? It's either someone else's or your own. So the longer you wait, the less opportunity you have to be paying down that principal, to be getting potential, equity built if the long-term plan is to hold on to that property. Now, does that mean prices can't go down? No, it doesn't mean any of that. I'm just saying, you shouldn't sit there and, in my opinion, weigh over whether or not today or next week or 6 months from now is the right time to buy a house because of everything going on, in the headlines. It's either it makes sense financially for you, it's the right time in your life, you can do it, you're comfortable with it, longer term time horizon, or it's not. And if it's not, that's okay too. Renting is okay. It's buying you patience to be able to get to that opportunity. But what I've seen many times in my career is a lot of people sitting on the sidelines guessing, whether is it today? Is right now the best time, or should I wait 6 months? Oh God, 6 months. Oh, I think it's going to get worse. And then eventually what happens is the market moves, they're gone. They never bought a house. I can tell you time and time again, several people that are sitting in that position, a lot of them are friends, quite frankly. So just don't fall into that boat. Make a plan, stick to it, and do what's right for you.
Hey, Jeb, we talk about when should you buy? You should buy when everything's right in your life, your economics for you and your household, your job situation, your family situation, and you're confident that you're ready to make that move. If you're asking this question, I'm not saying this is a fact, but maybe you're just not there yet. So make sure that you have got to that point where you think all of your ducks are in a row and you are happy and willing and able to be somewhere for the next 5 to 7 years. And at that point, buy whenever feels right for you.
Yeah, and I just popped up a couple of questions that people had on this topic, and it's we didn't direct the question directly to you, but that helps answer that question. Whether you're in Tampa or wherever market you're in, it's not about the headlines. Again, it's about the right time in your life. Anyhow, let's move along. Interesting question here. Matthew says, what happens to landlords of a property that is deemed a permanent crime scene? Thinking of a tragedy in Idaho or places where houses will likely be demolished by city order. So, honestly, I don't know the answer to that. I mean, there was a property in, I think it was Denver or Colorado, where there was another massacre type scene that happened. It was a father, family, the whole thing.
The other Netflix show.
Yeah, actually, that was it.
Yeah.
And I believe that property actually sold after the fact. I believe it was for sale. So, what happens is, I think as a landlord, you probably have to disclose that forever. I mean, by law, you probably don't have to. But yeah, I don't know. I mean, if it's deemed a permanent crime scene, maybe the insurance takes care of it. I'm not sure. Josh, any insight on that?
It's funny that Matthew's asking this question, because I was watching something on the news the other night about this, and they're going through it. And I kept looking at the house. And I'm like, there's no world in which anyone will ever want to live in that house, or any other college students in Moscow, Idaho will want to rent that. Mm-hmm. So the owner of that house, good luck selling it. It's probably going to have to be demolished. And most people, it's not like a lot would be stigmatized. Someone would say, yeah, it's very unfortunate that happened here, but the house is gone. The bad juju's gone. There will be people who be like, I don't want to be on that street. I don't want to be on that side of town, or I don't want my kids going to the University of Idaho because that happened there. I went to Eastern Washington University. We're about an hour away from Moscow. It's a cool little city, and it is mind-boggling that happened. And I think in smaller areas like that, if something like that happens in Los Angeles County, where there's millions of people, easier for it to kind of slip through the cracks, and people are more jaded by high levels of crime. If you're in a rural area, a part of the country like Moscow, Idaho, no one is ever going to forget that. The neighbors will tell you forever, you bought the house that happened. So there's no way that it wouldn't come out. My guess is it will be demolished. Someone will buy the lot and put another house on it. But in terms of economically, there's no protection for you. You don't have insurance for that. Your homeowner's insurance doesn't say, hey, sorry, a bunch of people got murdered on your house. We'll reimburse you to build a new home. You're going to take a loss on it.
Yeah. It's out of my wheelhouse there.
So thanks for bringing us down, Matthew.
Yeah, show's just gloom now. No, but in all reality, that's super sad situation. One thing I forgot earlier in the show, and I apologize for this, is Maddie came in as the show started with a $5 super chat, and I just now remembered it, but I wanted to make sure I thanked him for that. So thank you for doing that, Matt. That's awesome. We appreciate it. Let's see. There's another question that I got here that was good. Oh, Dina says, do buyers typically offer over asking on houses during winter market or spring market, or is it not predictable? I'm going to give you a scenario. So I was office meeting today. This is something that came up. So they were going over a city here locally in Orange County, and they showed that typically the list to sales price ratio for that particular area over the last year was at like 93 or 94%, right? This is Westminster, by the way. I mentioned Westminster earlier. So it was at like 93%. So it was quite a bit lower than the list price. Now, why, people overprice homes? Several reasons. But here's what's interesting. In the month of December, there was one property that sold, only one property sold in December, but the list to price ratio was at 103%, which is significantly different than the average over the last 12 months. And so one of the agents that works that market just happened to be in there and says, listen, that property was in my farm and they priced it significantly under value, which is why it sold way over the asking price and why that number is skewed. And the reason I bring this up is to answer your question in the idea of it's less about what the market is doing, what people are doing on properties, and more specific to the property in general. How did the agent price that property compared to other homes around it? If they priced it accordingly, then over the last year, the first half of 2022, that property probably sold over the asking price. Second half of 2022, if it was priced correctly, probably sold at the asking price, maybe even a little bit lower. What are you likely to see in the spring? It really depends on how people price properties. I mean, in our market here in Huntington Beach, there are still homes selling above the asking price when they're priced correctly, maybe even slightly lower than where they should be. Those homes are still selling where they should be, whereas there are overpriced homes selling less. So don't get so focused in hey, my buddy bought a house for 10% under the asking price. Okay, great. How is that property priced according to homes that have sold recently, not compared to where homes sold last year, and focus on that. But typically speaking, the spring is a hotter time of the year, right? A lot of people don't buy homes in the winter months for many reasons. Seasonality, in areas of the country where there's snow on the ground, and just it's difficult for many reasons for transactions to take place. Those markets heat up in the spring along with markets like California, and that's when home sales happen. And the same thing will be said this year. Homes that are priced right will sell at maybe even slightly above. Homes that are overpriced are going to sell below. So hopefully that is helpful for you. Rick asked the question of how would I go about renting my primary residence and buying a second as my primary home and repeating? Would I rent my primary out as a rental before I look for a second property? So Josh, when someone comes to you, they want to get pre-approved to buy another home. I'm a buyer. I want to buy a house. My family's growing. We're looking to upgrade. I've got a home now that I want to keep. Do I need to rent that property prior to having the conversation? What's that look like in the pre-approval process?
Not at all prior to having the conversation, prior to closing on the purchase. Just had a client here that they were in the Bay Area, I think San Jose, and ended up getting a job transfer. So they bought a house in Santa Cruz. They had a great rate and they had made a great buy on their house. So they wanted to keep it as a rental. What we had to do is once they found their home, they listed it for the current residents for lease. And by the time we closed, they provided us the lease agreement. So on the way in, we want to use a conservative number that we know that it will lease for, but we're going to use that. So in this instance, I think it was a nice house. San Jose is expensive. It was like a $4,000 rental agreement. So we're able to give you credit for 75% of that. The 25% allows for vacancy and maintenance and expenses there. So you take $3,000 and then you use that to offset your housing payment. So if your mortgage is $3,000 in that situation, it just washes it out to zero. If your mortgage is $2,100, now you have a $900 positive that we can add to your income for qualifying. Or conversely, if you have a $3,500 mortgage, we're going to have a $500 negative that is essentially treated just like a car payment or a credit card, any other debt that you have. So you're not having to qualify for both mortgages. You're qualifying for the net payment, net of the rents that you're receiving after the vacancy and maintenance and expense factor.
There you go. Good stuff. That point in the show when I'd like to ask a favor. If you're watching us on YouTube, if you could hit that thumbs up. If you're not subscribed to the channel, that helps more people see it. Helps that algorithm that everybody talks about. Helps get in front of more people. I appreciate when you guys do that. The goal with this channel is to educate, guide you guys through the process. And we're doing it here on YouTube as well as on the podcast. For those of you listening to the podcast, we also appreciate that. For those of you who aren't familiar with the podcast, we do have a podcast that's available Apple, Google, Spotify, all of those places. It's a deep dive into topics, our real estate topics. Here we answer a lot of different questions over the course of 2 hours. There, 20 to 40 minutes episode, kind of diving into something specific. We've done everything in the last 4 or 5 weeks to predicting what's happening in the housing market, to also guiding you guys through the process of the pre-approval process, writing an offer on a house, offer getting accepted. Now what happens? Really, just an A to Z on everything real estate. So if you're not listening to it and you're interested in buying a house, it makes a lot of sense to listen to it because it'll answer a lot of the questions that you guys have. So check that out and rate it, review it, all of that good stuff. All of that stuff helps. us ultimately accomplish our goal of helping educate more people. That's why we're here, is to educate. We believe that, having more educated buyers out there is a positive thing for the market, and it's a positive thing for those of you buying. So we
Jeb,
appreciate you. Yep.
I have two questions. While
Let's
I
hear
was
it.
having mic problems,
Mhm.
did you discuss the community? Do we want to tease it? Do we want to
No,
talk
no,
about it at
I did
all?
briefly. I mentioned the community. So if you look in the side of the chat there, if you're on YouTube, if you're listening on the podcast, it's in the description. It's actually in the description on YouTube as well, of a free community. It's a home buyer community. It could be a seller community. And what it is we often have people reaching out to saying, what are you guys reading? Who are you reading? What are you watching? Why are you watching that? What are your thoughts on this? And so what we decided to do was create a community where all of this information is there. It's free. You log in. Josh and I just started. I mean, we literally created this thing yesterday, day before. And we're just starting to post information in there, but it's going to be the articles that we're reading. It's going to be articles that we agree with, articles that we don't necessarily agree with, but it's just information that you guys should be paying attention to. And along with that, Josh is going to provide some rate updates, and it's really just a place for outside of here to get information and kind of follow along with what is happening in housing. And some of this data is stuff that we pay for, and we're providing for you guys, free of charge. And other stuff is things that you can find on the internet in multiple places, but we're putting it all in one spot. So check that out.
And it has a forum in there. So
Yeah. It's a place to ask questions
I'm
and chat.
ask questions, chat, start dating in case you wanted to, combine incomes. We haven't outlawed that yet. We'll see how it goes. If it gets out of hand, we'll have to stop it. But Jeb, my second question was, you mentioned they can get the podcast on Apple, Spotify, and all that. Are we on SoundCloud? I want to be on there with my favorite trap music. So can we get on SoundCloud too?
Probably. Yes,
Okay,
we probably need a
I'm
SoundCloud
gonna check
account.
into it. I'm going to check
and then
into
we
it.
have to do it. So yeah, I have no idea. Possibly. We can anything. We can be everywhere, Josh. That's the problem. Is we are everywhere. We got feelers out and all this stuff happening, but nevertheless, it's hard to be all these places at one time unless you're on the web. And that's what we're doing. So anyhow, I digress. All right. Let's see. Trey says, how do you get deals in a hot market that is one of the fastest growing markets? What are some of the metrics and calculations to get rentals? How do you get deals in a hot market that is one of the fastest growing markets? So are you a buyer? Are you an agent? Multiple ways, right? You could door knock, you can cold call. Neither of those I do, but I know agents that are successful doing both. I know, investors that do wholesale that do this sort of thing. You can send out mailers. There's multiple ways to get to it. Metrics and calculations to get rentals. I'm not sure I even understand that question. But if you're looking for a rental, you got to figure out what it's going to rent for. Got to figure out what your monthly expenses are going to be. You got to figure out how much your monthly payment is going to be on that property, so that you can figure out your cap rate on it. And you got to figure out if that makes sense to you or not. That's how I understand the question. So that's how I would approach it.
Jeb, why don't you clarify for them? So you mentioned wholesalers.
Yep.
And what in the world is a wholesaler? There are people out there who don't want to tie up their own money, who don't want to buy and flip houses, but they are in the market. They do this all day, every day. They put homes under contract and then they sell them to other investors. One came across my desk today as a house in LA. It was a duplex in LA. They wanted $510,000 for it. It's probably worth $650,000, and they probably have it under contract for $485,000, $490,000. So if you buy it from them for $510,000, they put $20,000, $25,000 in their pocket and move on to flip or wholesale the next property, and you get a below market price. So a lot of investors find that a worthwhile way to do it. Now, obviously, if you can eliminate that middleman and get in front of the deals yourself, then you can go and get an even lower price. But time, effort, energy, that's what that person is getting paid for. There are also companies that basically do marketing for cash offer leads. So you can buy those. They're about $100 a piece. So people wanting cash offers for their homes, you're going to go through maybe 5 to 10% of them would actually sell at a number that makes sense for an investor. So you're going to spend a couple $1,000s to get in front of one of those. So it comes down to where are you at What do you know? What are you willing to do and or pay to get in front of those deals? You're going to pay either in manual labor, like Jeb was talking about, knocking doors or making phone calls, or you're going to pay someone else for doing that manual labor to get in front of off-market deals.
There you go. T Tom 19. Any way to look for a property in California that has had someone pass away in it? There's not really a way to search that, but oftentimes if it's happened recently, us as agents, we see it in the MLS because the agents have to disclose if someone's passed away in the last couple of years. Within the last 3 years, they have to disclose that. So but what I'll say is more often than not, it's a peaceful passing. It's not something where you're going to be able to get some crazy deal on a property. But there's not really a way to search it, unfortunately.
Jeb, what is the requirement? So
3 years.
So 3 years. So as an example, that unfortunately we lost my dad in 2020. We were able to have him come home because it was in the middle of COVID. He was going to be in the hospital by himself. We were able to have him come home. So in May of 2020, he passed away in my home. So after May, I would no longer have to disclose that to anyone?
Correct.
And that doesn't change if someone is killed in my house or suicide or any of those other bad things.
Correct. Yeah. Correct. Could you? Sure, but you don't have to.
And a lot of that is truly cultural. Some cultures really, really frown on that and don't like it. And
feng shui is not, they're not into it. But yeah,
I don't think anyone's into it, but some people are less bothered by it.
Less bothered by it. Yeah. But I think it violates, feng shui, if you will. Violates probably not the right word. I'm not sure what the right word there is, but nevertheless. But Matty said he's in the community. So Matt, hey buddy, we can chat.
Nice. All right. Is Matt going to be the first poster?
It's like AOL instant chat.
AIM?
Like ICQ, like when I was in high school. We can send like little flowers to one another.
It's more like MySpace for mortgage and real estate is the way I would prefer to put it.
It's like Discord. If you've ever been on Discord, it's similar to Discord, but it's a lot easier to use, in my opinion. Right. Where are we, Josh? Where are we? I thought this was a good comment, so I just put it in here. Been waiting all week for today. My parents have 2 homes paid off with today's rates. What would be the best way to go if my parents want? Oh, I read it wrong. What would be the best way to go if my parents want to get cash to gift to me to buy a home myself? So if they own 2 homes that are paid off, Josh, what's the best way for them to access that cash?
So, since they're paid off, if they had a first mortgage, it would lean towards thinking in terms of possibly a second mortgage. So just use some random numbers. If the house is worth $400,000 and they owe $100,000 at 2% and they want to give you $100,000, it wouldn't make sense to refinance that whole thing. You would look at some type of second mortgage because the blended rate would likely be lower than what you can get today. Since they're free and clear, a first mortgage is going to have a lower interest rate than a HELOC, a home equity line of credit, or a home equity loan, which is just a fixed rate second. And it wouldn't be a second, it would be a first mortgage. So really, home equity line of credit or a new first mortgage, cash out. But in this situation, it would probably make more sense to just do a cash out refinance to get the money to give to you.
All right, there you go. Good. Let's see. Rick is asking a question here. A very profound question.
It's a good one. I like it.
That prices aren't going to fall, what, if anything, can our government do to make housing more affordable for first-time home buyers? Something has to give, right? Yeah. That's the problem is that I'll be honest, transparent. I don't know the answer. The easy answer is to build more property, right? And so you look at that and you go, okay, California is full of people. Where do you build more property? You build it inland. You build it in quote unquote less desirable areas. But people have to want to move out there and want to have to buy there and so on and so forth. But that's the easy answer, is to build more property. That's difficult for many reasons. So I don't have the answer to that question. Something I think about often, and I don't know that there's an easy solution. Josh?
So two pieces here. So the first part is kind of what you're addressing. How can we resolve it? It's simply supply and demand. So what can our government do to make housing more affordable? Here's the brilliant idea is let's go back to, say, 1995, which is about the last time our government was not aggressively and actively involved in housing. And there are people who will tell you I'm wrong, that it's back to about like 1975 before the government was meddling in housing. Let the market take care of itself. We had, people talk about lenders were terrible, brokers were terrible, Wall Street was terrible for pushing these bad loans. Well, that got started in the late 90s when the government decided that there are lots of good things that come out of high homeownership rates, so we should promote homeownership. Well, that's correlation versus causation. And by pushing people to become homeowners who are not equipped to become homeowners, or lowering the threshold or the barrier to become a homeowner and letting people across that threshold who haven't met the requirements, they set the stage for the big downturn. And then what did they do? They lowered rates and pushed things up. We had COVID. They put their hand on the scale, lowered rates, pushed things higher. So what I would say, what the government can do is stay out of the way for the next 50 years, and we might see something normalized. The second part of your question is totally logical and correct. Something has to give, right? So when people are making crash videos, when they're saying this market is going to drop 40%, they're looking at it and they're saying, every time historically we've got affordability in high-priced markets like Southern California down to these low levels, we've seen a major correction in home prices. And then they look back to the last correction and say it has to look like that. And they don't remember what were all the things that made that much worse than anything before. But there are multiple ways that a market can correct. One of those is you can have flat prices for an extended period of time. We've talked about affordability here and what that does. Rates can come down, prices can come down, incomes can go up, and time can be added to that, where incomes go up incrementally over time and correct that. So I would think, because we had 3 years here of way above trend home price increases, we can expect a period of below trend home price. So if you correct aggressively and abruptly, then that period is a short period of time. If you correct by being flat, it might take 7, 8, 10 years to see that. But what we're looking at right now is the supply and demand imbalance. Jeb talks about building more homes. In the most densely populated areas where the most high-paying jobs are, there's no more room to build more homes, so you can't have more supply. Sellers don't want to sell because they have really low rates. That's not adding to supply. And demand is low because we don't have the high levels of affordability from the chart that Jeb showed earlier in the show. So again, long answer to a short question. The government should stay out of it, and really 30, 40, 50 years, the market might correct itself to where it needs to be.
There you go. Let's see. Scarecrow is asking about buying or selling land in Missouri. I could not help you at all with that question. But if you do need an agent in there that can, there's a link below. Unfortunately, I don't know anything. I don't know a lot about selling land to start with because we don't do it here in California. I've only sold one plot of land in my entire career, and it's unbuildable because of a floodplain. But at one point,
how much did you sell it for, Jeb? How much did you sell the unbuildable lot for?
I think there was 825,000. Was that right? 825? Some absurd number at the time. But I'll tell you, during the pandemic, that probably would have sold over $1 million. But nevertheless, don't have a lot of experience selling just land by itself, and I definitely don't know much about Missouri. So unfortunately, I can't be of much assistance there.
Jeb, the only thing that I would add there is you can't just say the average price in Missouri. Let's say it's a piece of farmland 200 miles from the nearest town and there hasn't been a sale in 15 years. You're not going to get the average price. If you go to the prime piece of real estate in the downtown financial district of the most expensive city in
St. Louis.
the state, St. Louis, it's going to be way more than $7,000 an acre. So you can't just ask based off of state values. You got to say, where is it located? How close is it? Is it a populated area? Is it farmland? What can it be used for? What's the demand for it? What other lots are available? A lot of it goes into it versus just what state is the lot in.
There you go. Good stuff. Dragon My Baggage says, how about teaching this stuff in schools to prepare kids for it and not let them be blindsided by all this stuff? I think that's a great idea. And what we're trying to do with that is the podcast. Basically, that is a resource for basically anybody looking to buy a house. I mean, it is a deep dive into home buying in every facet, from mortgage to real estate. I'm in the business, and I think it's good information that everybody should know.
Well, Jeb, let me make a comment here. We occasionally get people on here. Oh, you guys are cheerleaders for the real estate market. You do mortgages, you sell real estate. I don't cheerlead anything. In the worst market that we've ever had, there were still millions of transactions being done. People are going to buy and sell homes. People are going to get mortgages, even in the worst market. We are here to give you the knowledge, information, and education so you could make the best decisions for you. So we want to be the school, the educated homebuyer university, Jeb.
That's what it's called, my friend. That is what it's called. Synaskamen. No idea, guys. And those listening on the podcast are probably like, what is he talking about? I'm reading names over here. Hello, guys. I don't know if anyone asked, but would you encourage someone to buy a house at the current time? 20 years old, would like to buy my first house this year and maybe rent some rooms. So we talked about, this question kind of earlier. I mean, it's not the best time to buy a house, right? Prices are high. They've run away from the long-term trend in appreciation. Rates are higher. It's a tough time to be a home buyer. Now, does that mean it's a bad time to buy? Not if it's the right time in your life. As a 20-year-old, you have a really long-term time horizon. But it comes down to what we've talked about many times on this show, and something I've mentioned several times tonight is, does it make sense for you right now? Can you afford the payment? Do you have money in the bank? Do you have a longer term time horizon? Are you going to be in that property for an extended period of time? Those are all things that's super important. At 20 years old, there's no rush to go out and buy anything. You have a lot of time to make these decisions. And it's probably not the right time in your life just because you are on the younger side, but it doesn't mean it can't be the right side. I mean, the right time, just based on, buying with friends or wanting to rent rooms or whatever. So again, it goes back to, where are you in your life at this point? And does it make financial sense for you today? And don't so much worry about what has happened in the market. Worry about where you are at this point.
I co-sign everything Jeb said, and he said, where are you at in life? I want to say, where are you at in the country? We talked earlier about the gentleman here in California who bought a rental property in Wisconsin, and $1,700 a rent, $1,800 a rent, and a $1,095 payment. If you're 20 years old and you get a 3-bedroom home with a $1,095 payment, and you can rent 2 bedrooms out for $400 each, and you're living for $295, it's a great time to buy a house. So look at the numbers, run the numbers. What are you capable of? If you're here in the middle of Southern California, I get this often. Folks calling saying, hey, I'm 25, just graduated from college. I can't afford, but I've got 3 friends. They all want to rent a room from me. So I just need a 4-bedroom house. They'll all pay about $800. So my salary is $80,000. And then I got another $2,400 a month. We can't use that income to qualify you. You don't have a history of it. If your friends had been renting from you for the last 3 years, you've been declaring it on your tax returns, then we can use it to qualify. So house hacking is a great idea. It's a great idea if you can get into the house, if your parents co-sign with you, and then you offset the payments by renting rooms to your friends. My nephew is in his early 20s. He bought up in the state of Washington last year, and he's got 3 buddies that live with him, and it subsidizes his costs so he can afford to own a home that he wouldn't otherwise be able to live in. But it's not quite as simple as people make it seem online. So just don't think that you can go in and use the projected rents from bedrooms in the home to qualify for your standard FHA, Fannie, Freddie loan.
All right. Scarecrow is back with another question saying, is it hard starting out in real estate with how competitive it can be? Sure. I mean, yes. The easy answer is it difficult? It depends. I mean, it's a competitive industry. There's a lot of people, a lot of competition. I mean, hell, everyone knows a real estate agent. Everyone knows a mortgage professional or a mortgage person. They don't necessarily be professionals here locally. So that can be difficult. And so, but like anything else, the cream rises to the top. So you could be, somebody that does very well very quickly. But what I will say is that it's probably going to be more competitive this year than it has been in a very long time, because there's going to be less transactions taking place, less sales out there. And with that, the competition is going to be high. People are going after the same deals. There's going to be a lot of deals that happen off market. In my opinion, there's going to be more of that happening in this world. And you're going to have a lot of agents that, that aren't in the business in a year, maybe even a couple of months, just because of that. So just make sure you plan. Maria's got a good question here. It says, in an event of a divorce, can you remove a spouse without refinancing to keep the low interest rate? So Josh, me and my spouse are on the mortgage together. Is it possible to remove them without having to refinance?
For the most part, no. And the reason being is these loans are securitized and sold off on Wall Street. There could be, if you saw, why am I drawing a blank, Jeb? What's the movie about The Big Short? And they go through how these mortgages are packaged up, sliced and diced and sold. There could be thousands of owners of your mortgage. So you can't really go to them and say, hey, can we modify this and replace me? Where I would be interested to see, and maybe I'll do a little research on this in the next week and see if we can answer this. Some of these loans are assumable because really what would a lender want to know? What they would want to know is that the remaining spouse can afford that payment. They qualified both spouses. So they want to make sure that the remaining spouse can handle it on their own. So if you could qualify and you could go and assume the loan, remove the other one from liability, it would be possible on the types of loans that are assumable, if I'm thinking it through correctly. But let me check and confirm on that and see if that's something that can be done. But your Fannie Mae, Freddie Mac loans, jumbo loans that are securitized and sold in the secondary markets, non-QM loans, very unlikely that you would ever be able to do that. And it's a problem, and what we see is a lot of people end up having to give up their awesome rates because the divorce decree says, hey, you get the house, but you have 12 months to get your spouse relieved from the debt.
No, there you go. I mean, I've come across that many times in my career of divorce situations and somebody wanting to keep the property and they end up having to refinance and or sell the property because they can't qualify for the mortgage by themselves. So let's see. Fresco Bar 170 says, do you guys think in our lifetimes, and I'm serious when I say in our lifetimes, we'll see a true buyer's market? Do you think that can be a real possibility? If so, how? What is a true buyer's market? One where they're just giving property away? I mean, that's like, I don't know. I don't think so unless you see some crazy thing happen with inventory. Now, can you see a buyer's market? Sure. I think you're likely to see one here really soon. I think you're in one now, even though by definition you're not.
So Jeb, what are those definitions? How would you typically define a buyer's market?
More than 6 months of inventory, and or homes sitting on the market for more than 120 days. Is typically what is referred to as a buyer's market. Now, what I will say is that average days on the market here in Orange County at the moment, I think is 84 days. Huntington Beach, it's quite a bit less, but Orange County as a whole is 84 days, and months of inventory, I think we're sitting at I don't know, couple of months of inventory, right? Significantly lower than the 6 months. In Huntington, I think we're at 2.12 months of inventory. So, but what I will say is it's more of a buyer's market than it's been in a very long time. And the idea that what defines a buyer's market? What defines a seller's market? It's when one party has the negotiating power, when one party has the upper hand, if you will. So does a buyer have an upper hand in this market? To some extent, they do. But a lot of it has to do with where the property is located, and how it's priced and all of these things to start with. But I would say the buyers have more of an advantage now is because homes are sitting on the market a little bit longer. There's less competition out there. Sellers are more willing to negotiate. As you guys saw, on one of the first slides that I showed, 40% of the homes nationwide at the moment have had some sort of price reduction starting the year. That's significantly different than where we were a year ago, 2 years ago, what have you. So the idea is that, it's more of a buyer's market. What's a true buyer's market? I mean, what I think I'm hearing when I say that out loud, based on what I'm reading, is that you're looking for an opportunity where there's just some big deal on a property. Will it happen in our lifetime? Sure. I think there's a possibility that it does. But that means more than what we saw, this last time. It means more of a 2008-ish event, right? Where you have some sort of financial collapse, nationwide, worldwide. But you need black swan event. You need multiple things to happen in order to create that. And I don't know if and when and how that all happens. That's way out of my realm. And I don't worry about what's going to happen 10 years from now. I try to worry about what's going to happen, a year, 6 months, tomorrow, that sort of thing.
What you would need is a supply demand imbalance, more supply
Largely.
than there is demand, a large one. And that's what we saw in 2008. So what is that? That's forced sellers. Right now, there are people who would be interested in selling and buying a different home, but they just aren't willing to do that. So kind of we talked about earlier, how can home prices correct over the long haul? You can have a period of below trend growth. So the answer to your question, a lifetime's a long time. I'm 49. I'm going to be 50 this year. Shocking.
Holy God,
John
50.
Pham called me the other old guy. The other old guy, Jeb.
You are the old guy, bro.
You're the old guy. I'm the other old guy. So, long way of saying, what, I got 40, 50 more years. I would think that there's going to be some things we can't even fathom in the next 40 years.
This guy just predicted his lifespan to go
100
to
years old, bro.
99 right there.
Yeah.
I like that. I mean,
on
I
the
do.
dot. I don't want to be 100.
I like it.
99 and I'm checking out.
But you just said that like it was like in the bag.
I'm breathing. Good. I'm breathing it into being.
I like it. Manifestation.
Will it manifest it? So
yeah.
But long way of saying we can't even project what will happen over. But I think in the near term future, we're unlikely to see that type of forced selling that makes a strong buyer's market. As Jeb said earlier, even though we don't have the metrics by definition, that call I was on last night, one of the guys is in Murrieta, California. He represented a veteran on a VA purchase here. They got a $20,000 seller concession. Like a year ago, if you had told someone, hey, you're going to get a $20,000 seller concession on a recently built new nice home in Southern California, they would have called you crazy. And we're already here. So again, we have no projection into the future. I think we're likely to see a protracted period of flattish prices, which doesn't really get to this big buyer's market where the supply demand equation tips in the favor of buyers.
All right, good. And Fresco Bar basically just came back out and said that it's more or less what we explained it to be. So not necessarily a crash, but one with months of inventory and negotiating power. So I think you're getting close. I mean, you're not crashing now. You got more negotiating power. You're getting a little bit more inventory. I think give it 6-8 months. And we could be in more of a buyer's market. A lot of it has to do with rates, right? We're going to know a lot more about rates over the next 2 to 3 months.
Did he, by the way, follow up with another comment and cosign that I will make it to 99 years old?
He did not.
I thought he did.
No, I did not delete anything.
All right.
Yet. Let's see. This is a good question. Miggy says, what's the best way to finance an ADU? So first off, let's talk about ADU. ADU is a granny flat. It's an accessory dwelling unit. It's an auxiliary dwelling unit. It's that little property, that little shed, that little she shed at the back of your house that could be used as a rental. It could be used for mother-in-laws. It could be used for the husband who gets kicked out of the house and has to sleep on the couch. But essentially, it's another little property on the property, if you will. They're becoming very, very popular, especially here in California, where now you can add an ADU with basically, you don't have to get anybody's approval, right? It has to meet city codes and what have you, but nobody can deny you an ADU as long as it's built to code. But Josh, what's a way to finance that if I don't have the cash? Is there a way?
So it's like financing anything else. You want to add on to your house. What can you do? You can refinance and take cash out. So the question behind the question here is, I have an awesome rate. I do not want to refinance to get the cash out. So it's a second mortgage of some type. You know, a year ago, this time last year, everyone was like, I'm getting a HELOC. I'm keeping my great rate. And that 3.875 refi is terrible. I'm not doing it. And now they're looking at a 7.5% rate on their HELOC. So that's why we talk about how much are you borrowing relative to the first. If you need $125,000 to build your ADU and you owe $500,000 on your first at 3%, then take a second mortgage, regardless of how high the rates are currently. Hopefully at some point in the future, you'd be able to combine the two of those into one lower rate loan. And you're always just looking at the blended rate. So what are your options? Cash out refinance. What's my rate on that? A second mortgage. What's the rate on that? How is that calculated to my blended rate for all of the finances, my first mortgage and my second mortgage? Do I have the cash? Am I comfortable paying cash for it and giving up the opportunity cost of how I can invest that cash? Those are really the only three ways of doing it.
No, good stuff. Can you get a personal loan for ADU, Josh?
Probably not for enough,
and then
as much as it costs to build one now.
And then, well, here's a question, side question. Can I get a loan some way build this ADU, and then refinance and have that somehow built into the loan of my property. Now, because in theory, my value is going to increase because now I have this additional property on there. Is that realistic, or is that completely crazy thinking?
Jeb, I'm going to plead semi-ignorance on this. I believe there were some changes to a few of the guidelines that paying off the construction cost of an ADU can be considered not cash out, but I would have to go and dig back into it. It's an area of innovation. The government is interested in finding ways to finance additional housing units in denser areas like Southern California. So they're trying to be as flexible as possible. There are some flexibilities there, but if I were to try and tell you guys right now, I wouldn't get you an accurate answer.
Good. Samuel has a couple of different questions here. The first one is relatively easy to answer. It says, does Josh have an Instagram? He does, but it would be like following the wall.
You'd see pictures of me from my 20s from when I last posted.
Yeah, there's nothing on there. So I'm not sure you would want it, but Josh can put it in the chat there if you want to. I think it's like Borrow Smart Josh. Is that what it is on Instagram?
Yep.
He does nothing with it. Second,
it sounds like a challenge, Jeb.
Oh God, I'd love to see you come through with this one. Samuel says, what are some good strategies on making offers in this market? And then goes on to ask the question is, what is the difference of getting a seller's concession versus getting a price cut? So there's a couple different things going on. What are some ways, some strategies to make offers in this market? I mean, no different than what you've been doing over the last couple of months. I mean, the biggest difference in this market versus the market last year is you're not having to give in necessarily to the seller's demands, right? Which means that you're probably able to keep your longer time frames with regards to your contingencies. You might not have to come in with the full 3% deposit here in the state of California. You might not be in a multiple offer situation. You're not necessarily having to go above and beyond the asking price, but we're getting back to a more typical market, which means I don't know that there's necessarily a strategy unless you're trying to accomplish something specifically with buying that property, right? If you're looking to maybe get the best deal on a property, but you don't care where you are, then you're looking for properties that potentially, been on the market longer, that maybe in inferior locations, that maybe there's something not necessarily, right with it. Maybe there's ways to potentially improve it, but for whatever reason, nobody wants that property. I mean, those are strategies on how maybe you get properties at a lower price, but what you don't want to do is go in and find the best house in the best neighborhood that's been completely remodeled. Those homes in most markets are still fetching a premium relative to other homes around it. So I don't know that I have a strategy for you other than look at comparables and try to figure out what you're trying to accomplish. The second question is a little easier to answer, and that's, the difference in a seller's concession versus getting a price cut. Well, a price cut is the price is, say it's 300,000. A price cut is now the home is 275 or whatever the number is. A concession is the price is 300 and now the price is still 300, but the seller is giving you a credit of 25,000. We'll use the same example towards your closing cost or to buy down the rate or towards something else. So the price doesn't change. You're just getting money to credit towards you. That would be a concession. I guess a price concession could happen. But most of the time when we're talking about these, we're not talking about that. So hopefully that helps.
Jeb, did you tell Samuel to ignore the pretty girls and find himself a straggler? Is that what you said was how you can get?
What happened? I did. Yes. Buy the ugly house. Buy the ugly one. Yes.
So what I would say, Samuel, there's an important discussion there between the difference between a concession and a price cut. And that is, let's say you're looking at a $400,000 house. Your closing costs are going to be somewhere around 12 to 15,000, including your prepaids to set up your impounds. So if you don't have that money and you only have, say, 3% for a down payment, then we don't worry about a price cut. You have to ask for that seller credit for you to even get into the home. Let's say you have that money. Now we have to make a decision. Would I rather give up the money and pay my own costs and have a lower price? Or would I rather pay the higher price and in essence finance my closing costs? Well, that's really what we're looking at here. And it's the same thing with the buy down. Do I want the seller to give me 2% to do a 2-1 buy down, or do I want a 2% lower purchase price? So you're throwing there, Francisco's asking the question, is the buy down only for 2 years of the term of the loan? There's a temporary buy down and there's a permanent buy down. So a temporary buy down is a 3-2-1 buy down, a 2-1 buy down, a 1-0 buy down. And that tells you how long the rate is going to be lower and by how much. So those are the questions that we have to ask. There's pros and cons, benefits to each. Do you have the money to do it yourself? If you do you value a lower price more than the extra money that you would have in your pocket if the seller pays it for you? And at current interest rates, this is a rough rule of thumb, but every $1,000 on the sale price saves you about $6. So if you ask for a $15,000 concession to cover your closing costs, it's going to save you, if instead you took a $15,000 price reduction, your payment's going to be about $90 lower, but you're going to have to come up with that $15,000. We say, I can get $15,000 for $90 a month. For most people, just from a monthly cash flow basis, it makes more sense to pay more for the home. If you're worried about the home price and you just want to get that as low as possible, get the thing paid off as soon as you can, then take the lower price.
All right, we got a lot of good questions here. We're kind of wrapping up on the show. I want to nail through some of these real quick, Josh, that, hopefully we can kind of
the speed round,
a speed round, if you will. So I don't know if you know the answer to this, but Rick says, does USDA have higher income limits for high cost areas? They do not, I don't believe, but do they? They do not. All right, there we go. Advantages and disadvantages of a single story versus 2-story house. So single story homes, typically, some of the advantages of a single story home is that there's no stairs, right? It's one level. You've got all types of generations that could move into that property. Boomers, the generation that looks to downsize are often looking.
Us 49-year-olds,
are often looking for single level homes, so that's an advantage. Single level homes feel more spacious, quite frankly, than a 2-story home of the same square foot. It's hard, oftentimes, to find a large single level home in a lot of areas, right? Huntington has a lot of single level homes because a lot of them were built in the 60s, but most of them, the square footage is awful, right? 1,300 square foot. So it can be tough, having a bigger family looking at single level homes. So that's, I guess, a disadvantage. I love single level homes. I would much prefer a single level home over a 2-story if I had the option. But it's kind of a preference thing. Some people prefer 2-story just because of the way they're set up. But single level, you need a little bit. If you're building the same size home as a 2-story home, you need a much bigger lot in theory to do it. Otherwise, you're taking the entire yard up, right? So that's why a lot of builders out there build 2-story homes, even 3-story homes in this market, is because they can build the same square footage on a much smaller lot, giving them a higher price point that in which they're able to sell. So it's kind of a, what you're into, but in lieu of keeping this short, like I said, hopefully that helps.
Yeah. Where's the speed round start?
Josh, own a $500,000 home free and clear on Social Security, disability income. So my DTI isn't working in order to get a loan. Any suggestions?
Boy, not really. Because if it's owner occupied, if it was a rental property, you can do a DSCR loan. You can do bank statements. You can do the bank statement on an owner occupied property, but bank statements aren't going to help you. It's not like you have a business and you're just not documenting your income. The problem for this situation is post 2008, the government requires a lender to prove your ability to repay. You don't have any alternative way of proving your ability to repay. So unfortunately, I don't have any good suggestions there.
What about a bridge loan? You have equity in a property.
It would have to be a business purpose loan because, again, it is your primary residence. The government requires even a hard money lender has to show your ability to repay. They went hard after hard money lenders saying, hey, this person has no way of repaying you. You loaned them $100,000 at 15% interest. You just wanted to steal their property or make them another loan next year, $100,000 more at 15% interest and charge them 5 points. So there's none of that. If it is someone's primary dwelling, you have to show that they have an ability to repay that loan. The way around it is a business purpose loan. If you had a business and you're willing to write them a letter saying, hey, I'm running a nail salon out of the garage and I need $100,000 cash to get it rolling, you might find a hard money lender that would be willing to do that. But you're talking higher interest rates and something that's not really going to help you.
All right. Angel says, my wife and I financed our home March 2022 using a VA loan. Thanks for your service, by the way. When can we finance another home? For reference, we make $14,000 a month after taxes. One house could eventually be a rental. So how soon after buying a property using a VA can you buy another, Josh?
You can't. So you can.
Well,
Let me explain. You can have multiple VA loans, but if you used, it's called secondary entitlement. So depending on what percentage of your entitlement was used up with that property, you couldn't buy another one VA unless you have enough entitlement left. But in terms of how long do you have to wait, there is no requirement of how long you have to wait. You can buy another home. But VA with zero down, you have to have enough entitlement remaining to guarantee the next loan. If it's short of that entitlement, then you can make a down payment with a VA loan and use a partial VA guarantee and partial down payment. So if you're in Southern California, let me know. We can walk through it. We can run the numbers. We can pull your certificate of eligibility and see how much of your entitlement was used. If you're outside of California, use the referral link. Jeb can get you connected to a VA expert that can walk you through that. But if you're not talking about a VA loan, just a conventional loan, you're going to make a down payment. There's no waiting period. Even if you're walking away and converting the VA to a rental and buying another owner-occupied property, you can absolutely do that. It's just going to require a down payment where the VA loan didn't.
All right, good stuff. I think that's it, Josh. So what I'm going to do here is I'm actually going to post something on the screen that I mentioned earlier. For any of you guys interested, I don't know where it is, so bear with me. Here it is. So free community. It is in the description of this video, guys. It's a community. Right? It's a lot like this. A lot of you guys show up every week. This is an opportunity to chat, look at the articles that we're looking, post commentary, a lot of stuff. So if you're interested, check it out. Again, it's free. We're not getting anything at the moment from it other than helping educate you guys. On top of that, if you haven't done so already, hit that thumbs up there. It helps, again, with the YouTube algorithm. There's a link scroll in the bottom that'll get you in touch with a mortgage professional, a real estate professional anywhere in the US. And finally, if you're not already listening to the podcast, do yourself a favor and check it out if you're interested in buying a home. Josh, any final words?
No, happy New Year. Thanks for showing up. It's January in Southern California. It's been rainy. It's been cold. It's been in like the low 60s. So I know many of you from around the country feel our pain. So thanks for staying in and spending a couple of hours with us. It's been a long time since we had the full 2-hour show. We got lazy through the holidays. So thanks for joining us.
We've had more rain in 2 weeks than we've had in like 2 years.
The last 4 years.
Yeah. But with that, guys, we appreciate you being here. We appreciate the opportunity to even serve and have this platform to help educate. But without you guys, we wouldn't be here. So thank you for that. We'll see you again next Wednesday.